On the program today, Zimbabwe-China trade surges nearly 30% to a record high of $2.43 billion in 2022. And Egypt's Commercial International Bank takes full ownership of Kenyan lender Mayfair. And in Ghana, total mobile money transactions in 2022 hit record 1.07 trillion cedis. Hello and welcome to Business Incorporated. I'm Will Ibang. As always, let's check in on major equities, starting with Africa, where equities traded with negative sentiments at intraday. South Africa was the biggest loser, down 0.8%. Nigeria was down marginally by 0.04%. The NGX has been trading on a high, but we're seeing it going lower these days. Now, elsewhere, Egypt's EGX 30 fell marginally by 0.6%, not marginally, but a huge percent, 0.6%, while Kenya closed Friday's session in the green territory. Now, let's see what's happening at the NGX with stocks. We have Oluwaseun Dosunmu is the head research party and securities to give us insights as what's ticking at the equities market. Good afternoon, Seun. It's good to have you on the program.
Good to be here.
Now, Seun, what's happening? We're seeing a marginal trade, negative territory for NGX at the moment. What stocks are driving this?
Okay, so thank you for that question. We've seen that activities actually slowed down, in the last couple of days compared to how the month started. And basically, a lot of investors are taking position from December. If we look at the monthly performance, you'd see that November and December actually closed in the positive. January 2 is also in the positive, around 2.7% currently, which is not bad. So some investors have been taking profits because, they actually took positions when stocks actually declined to the lowest points last year around October. So we've seen that some investors have been taking profits while others are coming into the market to make dividend plays. Now, the interesting thing is that we've seen some stocks such as GTCO, Zenith, NGX. We've been seeing a lot of activities. Investors are actually taking positions in those stocks. So what we decided to do was to look at the total value of transactions in the market from the start of the year till now. And we found out that the total value of transactions are about 89 billion. Compared to this period last year, last year was about 323, about that in terms of the value of transaction now, 323 billion. So we're seeing that in terms of the level of activities in the market, it's a bit lower. Okay. It's not surprising. Last year we had the listing of Boa Foods. We had additional listing of Airtel shares. So this actually spurred investors to actually take positions in the market, buy positions in the market.
Talking of positions now, Seun, we see this is earnings week. Well, we were already in the earnings season. How are investors positioning, and how do you think the market is going to close today?
We're quite optimistic about the market performance today, and that is because the numbers that have been released have been good. Out of right now, I think about 5 or 6 companies that have released their results, all of them have been positive. Most of them have been positive, So that would definitely drive positive reaction to the market. We expect more activities in the market because, like I mentioned in the last couple of sessions, the performances have been quite good. And this would actually drive investors more into the market because when you have the positive performance, definitely we expect better dividends to be paid for full year, for the audited full year numbers. So definitely we would see a lot of participation in the market.
You're saying, Seun, that you're bullish on the markets close today?
Oh, yes, definitely. We're bullish in the market.
Thank you so much, Oluwaseun Dosunmu, Head Research Party and Securities, for sharing your insights with that. We'll look out for that positive close.
Thank you.
So now over to the Middle East, where sentiments were mostly negative at intraday. We saw the Abu Dhabi being the only gainer there, up 0.04%. Dubai was down 0.93%. Still within the region, we see Saudi Arabia trading at 0.99%, almost 1% down, while Qatar index was down 0.33%. Now, we flip over to the EU, where Germany wants to transition to a green economy, and critical minerals are key in aiming to accomplish this move. German Chancellor Olaf Scholz has been trying to secure more access to commodities like lithium on a tour of resource-rich countries in South America, and in fact announced an expanded commodities partnership with Chile on Sunday. Yes, Chris Kober from Deutsche Welle in Berlin with more details on that. So Chris, what does this agreement entail?
This deal, which replaces a decades-old partnership, aims to intensify cooperation in the field of lithium mining, for example, through an annual bilateral forum and state instruments to promote trade like investment guarantees. Now, as we know, Germany has a huge auto industry, and for the sector, it is particularly mindful of securing more lithium. The ultralight metal is key to making batteries for electric vehicles. Argentina, which the German Chancellor also visited, and Chile, they both sit atop South America's lithium triangle, which holds the world's largest trove of the metal. Germany has fallen behind in the race for critical materials, in part due to a distaste for the dirty business of mining, as well as faith in the open market, German government officials say. Now, that has led to a reliance on China, which has invested widely in the mining sector in resource-rich South America and processing commodities. Now, though, soaring demand for critical minerals and geopolitical concerns are sparking a push to better secure and diversify supply, for example, through offtake agreements, stakes in mines, or possibly the establishment of Germany's own processing capacity.
You've already said that China has already invested heavily and widely in South America's mining sector. So why should countries in the region agree to closer ties with Germany, which Berlin is looking for at the moment?
Being late to the party, that's something that Germany has been grappling with on numerous occasions. After all, Berlin is hoping to strengthen ties with countries in Africa as well, while being confronted with strong Chinese presence in various sectors on the continent. And it is a similar picture in South America. So to get a foot in the door, or rather strengthen that foothold which Germany has, the country is offering what political leaders call a relationship on an equal footing and sustainability. Now, given the environmental, labor, and social concerns regarding mining that have sparked anger and thwarted projects in the sector, Germany's high standards made it an ideal partner. That is according to the German Chancellor's speech in Chile. Now, a new act that came into force this year, for example, insists high standards are observed throughout companies' supply chains. Germany also wanted to ensure mining generated more jobs in the source countries, the German Chancellor said. This new agreement between Germany and Chile could help pave the way here. Although success is not a given, a Bolivian-German lithium joint venture signed in 2018 fell apart 2 years later amid domestic political turmoil.
So what are investors in the financial markets looking at this week?
Many eyes will yet again be on central banks in this week. That is pretty much certain to see interest rates climb further in Europe and the United States. Investors are confident that the Federal Reserve will raise interest rates by 25 basis points on Wednesday, followed the day after by half-point hikes from the Bank of England and the European Central Bank. And any deviation from that script would be a real shock. Just as important will be the guidance on future policy, with analysts expecting a hawkish message of inflation is not yet beaten and more needs to be done. Fresh U.S. jobs and wage data may influence policymakers how much further they still have to go. Earnings from Apple, Amazon, Alphabet, Meta, and others will also be in the spotlight. Solid results could propel the Nasdaq to its best January since 2001.
Thanks, Chris Kober, for that insight. It's always good to have you on the program. Now we head over to the UK, where the Bank of England is poised to raise interest rates for the 10th time in succession. Our Juliana Olanka is there in London with more details. Juliana, it's good to have you. Juliana, UK policy makers are meeting this week in a further squeeze on the finances of mortgage holders and businesses. What are UK investors expecting, and how are the markets gearing up for this?
Good afternoon, Will. That's right. February 2nd, Thursday this week, is MPC Day, where Monetary Policy Committee members of the Bank of England will gather at Threadneedle Street to set interest rates in the UK, which are already really high at 3.5%. As you were quite right in pointing out, mortgage holders and businesses are pretty much on the brink because it costs so much to borrow. Interest rates in this country are currently at 3.5%. I think the financial markets have priced in a 0.5% rise. So that will be 4%, which would be the highest rate of interest in the UK since the financial crash in 2008. So it is being difficult. Of course, we know that, according to the word of Andrew Bailey, the Bank of England governor, the BOE are doing this because they want to try and bring down inflation, which is already at a 40-year high. Possibly could have peaked in November last year, but we just have to wait and see. And it is pushing businesses to the brink because it is costing so much at a time where we know that cash is just so limited. We are already hearing data from Barclaycard and from the Bank of England saying that mortgage holders are already defaulting on their payments because they've risen significantly over the past few weeks. You said already that this would be the 10th consecutive time that the Bank of England are going to be raising interest rates. But I think as well now, lots of people are going to wait and see what the forecasts are going to be by the Bank of England. They did say a couple of months ago that they were predicting that the UK would already be in a recession. It does feel like we're in a recession, but having a look at the latest GDP data that we received from December, it did show that there was a small rise. So perhaps we may have missed it, but the forecast for the rest of the year is pretty pertinent. So all eyes and ears will be listening to what the MPC have to say on Thursday lunchtime.
As we're keeping an eye on the UK, investors are also keeping an eye on the US and other EU markets, to the ECB, to see what they're going to do for interest rate hikes, and that's going to really determine the markets or the economy for most countries. Now, we'll just go away from that a bit and see that JD Sports Fashion has become the latest company to fall victim to a cyber attack. Last time we checked, it was Royal Mail. These attacks are becoming quite rampant, aren't they, Juliana?
They are actually, Will, and in fact, this is a developing story, so we don't have much details other than the fact that JD Sports, which is a huge sports retailer in the UK, unlike other high street stores which have been embattled since the pandemic, during the pandemic and after, JD Sports has managed to stay way above that, reporting pretty robust sales over the past couple of years. But they have announced just a couple of hours ago that, yes, they are the latest in a series of victims of cyber attacks. This is expected to have impacted the details of about 10 million customers who have used the JD Sports online store between, I believe, October 2008 to October 2020. So this is going to impact people's names, addresses, email addresses, and a slight piece of detail from your card. Now, JD Sports have said, don't panic. You don't have your full details on display, but they are advising customers that over the next couple of days, if you do hear from JD Sports, just be very, very cautious, because that perhaps may not be JD Sports. It could be one of these members of this criminal gang who have managed to infiltrate their system. As you said, it's a huge issue, not just in Britain, but across America. In fact, across the world, these ransomware, cyberware attacks, whatever you call them, are impacting customers. So if you are watching from the UK, you have used JD Sports like I have over the past couple of years, just be very, very cautious if you get any text messages, emails or phone calls from JD over the next couple of days, because quite likely it isn't them and it is somebody that's trying to hack your details.
So our markets reacting to all this news, are they looking good at intraday?
Not looking great, actually. We did have some developing news from 888 Holdings, which is an umbrella company for some of the world's biggest gambling sites. 888 Holdings sits on the blue chip index. They've just announced that their CEO is leaving because there does appear to be some sort of scandal involving money laundering and the firm in the Middle East. So apparently, at the moment, 888 Holdings is not operational in the Middle East. It's a developing story. Hopefully we'll be able to bring you some more of that during Business Morning tomorrow. That's really dragged down the blue chip index at intraday, which is down 0.22%. FTSE 100 down 2 at 0.15%. And the FTSE 250, the domestic market, that's down by nearly 1%, 0.89%. In the currencies market, the British pound is currently trading down against the US dollar by 0.05%, down 2 against the euro by 0.34%. But the British pound at intraday is trading up against the Japanese yen by 0.05%. Well,
thanks so much, Juliana, for the updates. It's always good to have you talk to us about this, and we hope tomorrow will bring better news.
We hope so. Thank you.
Now, stocks in Asia-Pacific fell mostly on Monday. Mainland Chinese markets rose on resuming trade after a week-long New Year break and are headed for a bull market. The CSI 300, which tracks the largest mainland-listed stocks, have gained about 20% from its recent lows seen at the end of October last year. The Shenzhen component rose 1% and the Shanghai composite rose 0.14%. Bucking the trend in the wider region, Hong Kong's Hang Seng Index traded 2.73% as property and technology stocks led losses. In Japan, the Nikkei 225 gained 0.19%, while the Topix was just below the flat line. South Korea's Kospi fell 1.35%. The S&P ASX 200 in Australia fell 0.16%. Investors are also digesting trade data from New Zealand. International research institution Fitch Solutions expects regional growth in sub-Saharan Africa, SSA, to pick up this year. And this is despite a muted outlook for major markets. Fitch Solutions recently held its quarterly event where it discussed key themes for sub-Saharan Africa's macroeconomic outlook in 2023. But before we have the conversation, we'll look at other markets where we see Zimbabwe and China's trade bumping up this year. Trade between Zimbabwe and China surged 29.2% year on year to a record high of $2.43 billion in 2022. And that's according to figures from the Chinese embassy in Zimbabwe. Zimbabwe exported $1.3 billion worth of goods to China and imported $1.13 billion worth of goods from China. China mainly imports from Zimbabwe tobacco leaf, processed tobacco, ferroalloys, and chromium ore. Over the past year, China has made major investments in Zimbabwe's infrastructure and mining projects as two countries continue to boost economic and trade ties. Now we see Egypt in further takeover of the central bank in Egypt, taking over the Kenya Mayfair. Egypt's Commercial International Bank has taken full ownership of Kenya's Mayfair CIB with the purchase of 49% of its shares it did not already own. According to the Kenyan Central Bank, the acquisition, which takes effect January the 31st, will anchor CIB's expansion into the East African region. Additionally, it will strengthen the trade and investment ties between Kenya and Egypt. In 2020, CIB bought a 51% stake in Mayfair, the skills and infrastructure to speed the tiny Kenyan lenders' growth at a time when it accounted for only 0.2% of the East African nation's banking market. Now back to our conversation with Fitch Solutions. We're having John Kapati, Senior Analyst, Country Risk, Sub-Saharan Africa, to talk about the macroeconomic themes and the outlook for Sub-Saharan Africa. Good afternoon, Gianmarco. It's good to have you on the program.
Hello, thanks for having me.
And so we've seen, and one of the key themes for Sub-Saharan Africa that you mentioned for countries, you say you see a moderate pickup in economic momentum, which of these countries are expected to drive this growth?
So we see a very moderate uptick in regional growth from 3.4% last year to 3.6% this year. But the largest four markets will actually see growth weakening. And we continue to flag high downside risks, including for South Africa, where the central bank just recently revised down its own projection for this year's growth to just 0.3%. Also, our main point is that regional growth will remain well below the average of 4.1% between 2010 and 2019. And for a group of mostly frontier or emerging markets, that's not the growth rate you want to end up with, as it's probably barely above population growth. Now, there are some good stories. We think East Africa will be the main engine of regional growth this year, and especially Tanzania, where we expect strong investment-led growth, and Ethiopia as well, where we see the economy recovering from a 2-year conflict in the north that just ended with a recently signed peace deal. And then West Africa, despite weak performance by Nigeria and Ghana, we see strong growth in economies like Cote d'Ivoire and Senegal. And here again, lots of investment into the gas sector for Senegal and strong public investment in infrastructure projects in Cote d'Ivoire as well as very low inflation there by regional and global standards.
And so what are the major concerns for the countries expected to underperform this year?
So each of these economies has its own domestic challenges, but there are some common themes. In South Africa, for example, the main drag on growth at the moment is worsening power cuts, and this is just crippling activities, forcing firms to delay much needed investment that could help reverse the decline of the economy. And on a political level, this just fuels discontent at a time when we're seeing lots of strike action over rising living costs, and it will threaten the performance of the ruling party at the general election next year. We think it's going to really struggle to obtain a majority for the first time in history. In Ghana, we've seen weakening investor confidence, driving a sell-off of the currency, pushing up inflation to about 50% in November, and the ongoing debt restructuring process by the government will cap sentiment in the near term. And again, with implications for unrest and the 2024 elections, where we expect the current governing party to lose. Similar inflation dynamics in Nigeria, and here we think this will compound the impact of falling oil production and moderating oil prices. So we forecast growth to continue to slow to just about 2.5% this year. And again, next month's election is probably going to be very closely fought and potentially highly contested. It's a tricky time for these economies. And in Nigeria and Angola, falling oil production really underscores the importance of diversification and good management of natural resources, which hasn't really been the case, especially in Nigeria.
So you talked about Ghana's currency being impacted. How would other currencies on the region be impacted by this underperformance or the outlook you've just projected?
So the factors that are weighing on growth in some of these markets are also affecting the currency outlook. So in short, our view is that the US dollar has peaked and will weaken a bit this year, but not every currency in SSA will be able to benefit from this. So on the one hand, we have currencies where we expect strong performance, such as the West and Central African CFA francs, which are pegged to the euro and will likely appreciate a bit over the course of the year. The South African rand, the Kenyan shilling, and the Ghanaian cedi itself will remain on varying degrees of depreciation, but more moderate compared to last year, as they're helped by the weakening dollar and a slightly better appetite for emerging market assets this year. Now, for some currencies, we actually expect a worsening outlook. So once again, falling oil prices and domestic oil production will take a toll on export receipts in Nigeria and Angola. So obviously their currencies, the Naira and the Kwanza. And despite an improving security situation in Ethiopia, the country is a big wheat and fuel importer. So the rally in prices last year has really depressed foreign exchange reserves. And we think this will prompt the central bank to increase the pace of devaluation of the Ethiopian birr this year.
So you're looking at this bleak projection you just given now. You do expect, Fitch Solutions still expect the monetary policy tightening to slow in sub-Saharan Africa in the second half of this year. This is despite high inflation levels and fiscal policy dilemmas that the countries are facing. How would that work?
So we think monetary tightening will slow despite still elevating inflation, which we forecast will ease from around 18% last year to about 14% in 2023, so still above the past 10-year average of about 10%. And reflecting this, we expect some more tightening, especially early in the year, in countries such as Nigeria and Ghana and South Africa. It happened last week, before central banks begin to then hold policy rates in line with the US Fed, or in Angola even cut them because they have space and inflation has been slow in there. As for our fiscal policy theme, we think rising government spending on debt servicing will reduce fiscal space and create policy dilemmas for governments. Now, because we think policy rates in developed markets won't be cut until 2024, and some risk aversion will persist due to recession fears, we think bond yields in SSA will remain elevated this year. So still tight external financing conditions, and this will force many governments to continue relying on domestic debt, which usually comes with higher interest costs in SSA. So despite pressure to keep anti-inflationary measures and subsidies in place, governments will have to make tough policy decisions to find room for that, especially as interest rates remain high domestically. So all the policy measures that could make up for that are hiking taxes or cutting other areas of spending. So we think more countries are likely to resort to IMF lending, like in 2022, and actually a new program was approved just last week for Mauritania.
Okay. Thank you so much, Gianmarco Capati, Senior Analyst, Country Risk, Sub-Saharan Africa, Fitch Solutions, for joining us on the program today.
Thank you.
Now in Ghana, total mobile money transactions in 2022 hit a record 1.07 trillion cedis, despite the existence of the Electronic Transaction Levy, that's the e-levy, according to the January 2022 summary of economic and financial data released by the Bank of Ghana. This is the biggest transactions occurred in December 2022 and November 2022. There were fears that the implementation of the e-levy in May 2022 was going to affect mobile money transactions, but that has not been the case. From the data shown, mobile money transactions have been surging since the implementation of e-levy in May 2022. And that's it on Business Incorporated. I'm Will Ibang. Thanks for watching. Bye for now.